Howdy and good afternoon. It's Jed Wonderly with Noble Home Loans, and I just wanted to give you a quick update along with some explanations about what's going on in the mortgage bond market. So we'll get started right now with the Mortgage Market Minute. So we've got the most important week of the month as far as economic data is concerned. And that means we start off on Wednesday with the ISM manufacturing report, which came in just a wee bit weaker than expected, but very strong still at 59.8. Expectations were for 60.3. Now, that's the end of coming in weaker than expected. Adp Private Payrolls on, the ISM was on Monday, my bad. The Adp Private Payrolls kicked off the important part of the week. The Wednesday through Friday period of the first week of every month is huge with lots of jobs data and all sorts of other important stuff. But the Adp Private Payrolls came in at 230 versus estimates of 185. 185 would have been very solid, very strong, but 230 is huge. So then you have the ISM Services Index, which was expected at 58, came in at 61.6. That is a huge number, and far beyond expectations. So there we go for that. And again, initial weekly jobless claims, which is making a habit out of coming in lower than expectations, which is a good thing. That's one of the statistics that you want to come in lower. And it did at 207,000 versus estimates of 213,000. So again, like I've been saying every week on every show, that every one of these videos, that the economy is just smoking along, and because of how strong it is, that is going to adversely impact rates. The Fed does not want to let inflation get away from itself, get away from us, and we really need to kind of make sure that we keep it under control. And with that, that's where the interest rate increases come in, make it a little more expensive to borrow money, and kind of rein things in from the consumer perspective, because when money costs more, there's not as much borrowing going on. So with that, we had a huge sell-off yesterday with the mortgage bond market. You may recall if you watched last week's video that I said the price point of the Fannie Mae 4.0 benchmark bond was getting to a point where it looked like they were probably going to change it to the next bond in the series, so which would be the Fannie Mae 4.5. It happened today. After that huge sell-off yesterday, they basically had no choice, because it was just 27 basis points above 100 at that point. And when it gets that close to 100, then it's really time to change it, and they did. So the new Fannie Mae benchmark bond is the 4.5 yield. So we can look at the chart, and here's the sell-off yesterday that happened on the 4.5. It wasn't quite as bad as the 4.0, as you would expect. And currently, we are down 2 basis points today. We're seeing a little more sell-off on the Ginnie Mae, which is the bond that determines pricing for, or rates, I should say, for FHA and VA. So that we're down a little bit more there, but it wasn't down quite as much yesterday as the Fannie Mae bond. So the good news is that the RSI is oversold, but I wouldn't expect much from that. The other thing is we have a new support level to go with the new bond. We are knocking on the door. We're just a little bit above the support level, number 1, at 102.4. And if we break through there with any seriousness, then there's quite a ways to go. There's not really any support under that, other than maybe the possibility of some investment opportunities into bonds by the investors. So that's where we are at. We've still got some more very important economic data coming out tomorrow. So like I've been saying lately on every one of these videos, if you can lock, lock. Protect yourself from the downside. That's what I've been saying. Protect yourself from the downside. And you can see here, there's been a huge downward movement. Yesterday, I calculated the change from August 27th till yesterday. The downward movement was, in the 4.0 benchmark bond, was 174 basis points. That's a little over 3/8 in rate. That's like 3/8 and a half in rate. So that's huge, especially over just 1 month period of time. So, you know, if you were looking at 4.5, you know, or 4 5/8 on August 27th, as a, you know, just an example, you'd be looking at about 5 as of yesterday. So I would say, like I've been saying, if you can lock, lock. If you're not in a position to lock, get there. There's certain things you need to do. You need to fill out a loan application, provide your income and asset documentation. Hopefully you have a property, but if you don't, we have the ability to lock without having identified a property. We can lock up to a year. So I'd love to help you with that. But regardless, if you're already in process with somebody else, I'm happy to give you a quote to compare us to them and let you know some of the things that we do differently. But most importantly, get to where you can lock and protect yourself from any further downside. Because again, with this kind of economic data, it's going to put a lot of pressure, selling pressure on the bonds, which, you know, rates move inversely to the price of bonds, and so that would mean that rates would be continuing to move up. So that's all for today. I'm going to be out, and hopefully I'll have another video on Wednesday, but I'm going to be out of town for about 4 days. So hopefully the market doesn't go to heck in a handbasket while I'm gone. But regardless of what it does, hopefully you're able to lock based on the information in this video and protect yourself. The other side of the locking now and protecting yourself from the downside is that if the market does for some reason get better and rates improve, hopefully the lender you're using has a float down option. We do. Please contact me if you'd like to learn a little bit more about any of that. But I'm happy to help in any way I can, so feel free to, you know, message me or call me at 702-812-1214 or 801-893-1737. Look forward to talking to you, and make today great.